Rohr here with an early concise highlight on Thursday, July 2nd, 2015. It's currently 7:45 a.m. U.S. Central Time. We're coming to you a bit later than usual because we wanted to see the market responses to the U.S. employment report after the earlier notification email we put out with the basic breakdown of market levels. And that report was weaker than expected. After ADP was stronger than expected on Wednesday, people ramped up their estimates from the low 200,000s, but in fact the number came in at plus 223,000 jobs, pretty much in line with the previous estimates from earlier in the week, but also there was a 60,000 downward revision to the previous 2 months' payrolls, and the hourly earnings were flat after the first sign of light last month at plus 0.3. That brings back into question the nature of the jobs being created regardless of the number. There are quite a few other macro factors that we will also review briefly straight away. So, what does this mean to the markets? Well, as usual, we've got our 60-minute S&P 500 chart on the left, September futures 30-minute chart on the right, and right now what's going on is the S&P 500 is up 5 at 2076. Now, this is very important because that puts it back up into the 2075 to 78 range. That's the classical congestion that we focused on for a while now. And that would mean also you have a 2079 down break going back to the big gap lower opening on Monday. And that's all very important then, because much above that, the market's entitled to go back up at least to 2088 to 90. In other words, close off the trading gap. And the gap back up to the close is right up to the low end from last Friday of 2096 to 2100. But first we have to see if this gets convincingly back above 2075 to 78. If it does, we suspect that the hourly MACD will also be pushing back above the upper runaway band, and that will provide the basis for some sustained strength. Now, what's most interesting about all this is the bigger low-end support, as we'll see on the intermediate term chart, was down in the 2040 to 37 range. Those were the multiple tests of that area back in March when the market slipped below 2060, but was interesting in holding up no worse than this range. And 2060 to 58 was the near-term more prominent congestion, and it got knocked below it on Monday on a just what we called greased lightning. This was like a lightning bolt coming down from the storm clouds up here, and yet even though it opened above it on Tuesday, had trouble staying back above 2060. But once it gapped above it Wednesday, on the pullback Wednesday, very much more orderly and quiet, and even trying to conform to this overall downward channel since this last significant high back here up into the 2119 to 23 resistance, this up break from right around 2062 after holding around 2060 was a key sign. And we felt it was just the sort of thing that presaged some further strength today, which we've got. Just how much is going to be very interesting. That pretty much does it for the short-term view of the S&P 500.